My topic this afternoon is to look at island economies and to consider what lies behind their productivity and prosperity from an economic perspective. You may well be familiar with a lot of what I'm going to say, but it should be a useful exercise to try to bring the strands together. We are essentially analysing small economies surrounded by sea. We're looking at economic prosperity and also economic survival. In reality, the economic objectives are the same in island economies as they are in large economies, which is essentially maximising economic growth or GDP per head. But at the outset, I would say that there are both positives and negatives in being an island economy. The big positive factors are the potential benefits from an ability to draft your own laws, set your own taxes, and react quickly to outside events, giving flexibility and, as we said before, and hopefully nimbleness. However, that is offset by constraining negative factors. And here I think it helps if we look at the characteristics of island economies. They are characterized in the first instance by resource constraints, limited natural resources, limited land, limited commodities, limited energy sources, but also limited manpower resources. You've got a finite labor force and finite supply of expertise. But you mustn't forget externalities. Now, what do I mean by that? I mean, really the vulnerability to economic conditions elsewhere. You can't insulate yourself from the rest of the world economy. Similarly, there's a vulnerability to economic laws and policies created elsewhere, and we are conscious of that particularly from the UK and the EU especially. And furthermore, you're still subject to global regulations, for example, the FATF rules. You're still subject to global regulation with only a limited ability or no ability at all to influence those regulations. So what? Well, to prosper, it helps if you identify your competitive advantage, and here there is a natural overlap with William Mason's presentation. And I will focus on one of his themes where he said, and it was a quote something like this: "Our competitive advantages require constant nurturing and development if they are not to be lost." Indeed, competitive advantage is a relative concept, and in fact, historically, economists focused on comparative advantage, not competitive advantage. But the point is, competitive advantage is not a fixed endowment. It can be eroded. Indeed, it is usually time limited as competitors seek to imitate your model or your best ideas. Guernsey invented protected cell companies, PCCs, but others copied the idea. Is that fair? Well, it seems like all is fair in international trade as well as all is fair in war. No hard feelings then, and remember, we borrowed the captive insurer concept from Bermuda. Now, clearly you will all be familiar with our experience and that of the other crown dependencies, and I have experienced it in two other island economies, and that is that the chosen model among island economies predominantly is to channel competitive advantage through financial services-based businesses. And that financial services-based businesses approach chosen by many island economies sets out to achieve high value added per head of a finite workforce. It has the added incentive of an easy source of potential tax revenues. And on the face of it, this financial services-based approach looks attractive, easy, straightforward. But I would argue, actually, it's a constant hard slog. And the reality is, you have to deal with the downsides. The classic downsides, although the international community keeps moving the regulatory goalposts, heard a bit about that before, you'll have to endure constant criticism of the integrity of FSBs, and island economies quickly acquire negative labels, typically tax havens or no questions asked places of business. You can think of others, and so on. So what? Well, island economies need to be constantly alert to such accusations and deal with them effectively by deploying the facts to set the record straight. And you will recall the recent experience of that here in Guernsey in respect of the EU, the so-called EU blacklist. So if you are living in what I call a reputation-sensitive life, the only effective response is to build a robust anti-money laundering and anti-financial crime infrastructure. Now, economically, that impacts the business model. It skews the cost-income ratio by necessarily increasing the proportion of non-revenue generating staff. But there it is. We've now been in this territory long enough to know that there's no alternative. Moving on. When we talk of economic strategy, we inevitably talk about diversification. And with such constant challenges to that financial services-based businesses sector, most island economies naturally strive for some diversification. Why is that? Firstly, to reduce the concentration risk, to avoid having all your eggs in one basket, but also to mitigate the impact of external shocks. And rest assured, there will be external shocks will happen. However, I would distinguish two aspects of diversification. Diversification across the whole economy and also diversification within the FSB sector. In aspect one, diversification across the whole economy, most island economies choose tourism. They're surrounded by sea, but also sometimes horticulture. The problem with tourism is its seasonality and its weak multiplier effects, as in the cruise ship example. The passengers don't spend enough off the ship. There's nothing new in this. I mean, I saw this 40 years ago as an economic advisor in Bermuda. On aspect two, diversification within the finance sector, that is already a feature of the Guernsey economy. It can be described otherwise as the complementarity of the different components of the finance industry, i.e. the different components help each other. The trust sector helps banking with liquidity, banking helps insurance with standby letters of credit, and the trust sector has access to locally provided investment management services. Okay, we talked about growth and diversification, but before dealing with innovation, there is a caveat in the wake of the 2008 crisis, which flags the ever-present danger of complacency. In our Guernsey's chosen subsectors of wealth management and private banking, there is an ongoing challenge, which is why I call it a caveat on standing still. And it is evident that wealth managers must demonstrate value added and value for money. If you can't justify the fees, then the business will evaporate. Clients and investors will reasonably ask, what am I paying for? And with historically low interest rates and slow economic recovery, this is ever more challenging. The response must be smarter, better educated wealth managers and advisors who understand and can interpret complex markets for clients. So the clients get to feel that they're getting something more than they could from just following the news, and they can get something customized for them. Moving on to the ever-present topic of innovation. My view is not a solution itself, it's just a subset of diversification. Our experience at the Commission is that there's very little is wholly new. There's just more efficient ways of doing what has been done in the past. But there is a clear message here that financial services businesses will have to embrace smart applications or get left behind by their competitors. In effect, you have to keep moving forward in order to stand still. On innovation, I believe there is an exciting future. The crowdfunding and peer-to-peer lending has been enabled by new technology which creates smart platforms. But this whole sector is still evolving. No one single model has emerged clearly above the rest, so the future direction is not obvious. In my view, peer-to-peer lending could go full circle and end up back with the bankers, who are the guys with the expertise on credit appraisal and credit assessment. Anyway, drawing the strands towards a close, let me return to the point that competitive advantage can evaporate or be lost. And there's a common sense message here for island economies. Do not get too committed to one line of business or one specific market that you could be left stranded. And that point is also echoed at the micro level. The Commission's full risk assessments under the PRISM methodology, which you'll hear more about later today and tomorrow, focuses on business models. And certainly what we found from the full risk assessment so far is undoubtedly that the stronger firms are those which diversify their lines of business and are not monoline businesses. So finally, let me recall a few cautionary tales where diversification did not turn out quite how it was intended. Time only allows me a brief review of the experience of 3 island economies, but you may be able to think of some other examples. Firstly, Iceland. Iceland attempted the big diversification away from natural resource-based industries, fisheries, geothermal power, to international banking. Unfortunately, it became a diversification too far and ended, as you may recall, in tears with the collapse of the economy. between 2003 and 2008, the three Icelandic banks ballooned their balance sheet, eventually building up to assets totaling 11 times the country's GDP. To do that, they borrowed short-term debt in the international markets and also raised deposits overseas, particularly in those IceSave accounts in London, UK, and Netherlands. Unfortunately, Iceland was unable to refinance those short-term debts, and this somehow precipitated a run on deposits. Given the scale of the combined bank's balance sheet, the Central Bank of Iceland was unable to act as a lender of last resort to those three banks. And then default of the three banks followed, and then onwards to the collapse of the currency and severe economic depression. Secondly, brief mention of a diversification story in Bahrain. This is a different story. This was a diversification away from heavy capital, intensive oil and energy related products, refined petrol products, petrochemicals, aluminium smelting. The diversification was to banking and in particular offshore banking. They had seen an opportunity to replace Lebanon as the primary Middle East banking center after the civil war and devastation in Lebanon, and move into financial services, which had the benefit of employing the well-educated workforce. Now, when I was there, they had just created the concept of an offshore banking unit, or an OBU, and expansion continued through the 1980s and most of the 1990s. However, the Iraq War and Saddam Hussein's military activities effectively brought an end to its growth. I mean, I believe that the trigger event was the landing of a Scud missile on Manama Airport, which put the bankers to flight, and they decided they felt safer further down the Arabian Gulf in Dubai. You can't blame them for that. With that said, Bahrain is still a good place from which to do business with Saudi Arabia, but it has never recovered as a regional center. And the third example is Cyprus. Cyprus successfully diversified away from tourism into offshore banking and financial services. Again, the island had a well-educated workforce. The instrument which helped them expand into financial services was a double taxation treaty, firstly with the USSR, i.e. the Soviet bloc, and subsequently Russia. The two big banks, Bank of Cyprus and Cyprus Popular Bank, prospered and grew. Meanwhile, the island had decided to apply for membership of the Eurozone and eventually adopting the euro. In order to grow further, the big banks decided to diversify overseas away from their domestic market. And it was the main focus of that diversification which caused their downfall. The market in which they decided to expand significantly was Greece. And they established extensive branch networks there. After the financial crash, Greece went into economic decline as the recession took hold. The banks, which had lent extensively to both individuals and to local businesses, eventually suffered a big rise in non-performing loans and bad debts. And it was this, along with the fact that the banks were also holding large amounts of Greek sovereign debt, which led to their collapse and the need to apply for an EU bailout, which was, as you may recall, incredibly tough on the Cypriot banks and on depositors with Cyprus banks. So let me wrap up and suggest a way forward for island economies. So to stay competitive and survive, it makes sense to keep a mix of financial services businesses and financial products. Keep open the supply of expertise. I mean, this is the lifeblood of island economies, as we touched on before. Keep developing educational standards. Aim for smart people doing higher value added jobs. Crucially, don't price yourself out of your market. And we know that Switzerland at the moment is suffering from the strength of the Swiss franc, it's seen as a haven from the uncertainties around the euro. Also, embrace innovative applications, and finally, and almost goes without saying, maintain a top-notch infrastructure. Well, there you have it. I think that's probably enough for me. I hope you found that economic overview helpful in giving you some economic context to the rest of the proceedings, both this afternoon and in tomorrow's sessions. Thank you for listening.